This topic is about alternative investment features. From Learning Module, Alternative Investment Features, Methods, and Structures. Alternative investments usually have longer investment periods, reduced liquidity, and less efficient markets than traditional assets. Traditional investments, such as public stocks and bonds, normally have high liquidity and shorter holding periods. Liquidity and time horizon are key differences. B is correct. Infrastructure is a special type of real asset, with long-lived fixed assets for public use and essential services. It is often developed through a public-private partnership, or PPP, where private investors have a stake, usually with a concession agreement for construction, maintenance, and operation rights to earn fees. Examples include bridges and toll roads. Farmland and residential apartments are real assets, but not infrastructure, or typically PPPs. Correct answer is B. Investors seek greater portfolio diversification and/or higher expected returns from alternatives. A key feature listed is typically low correlation of returns with more traditional asset classes. This low correlation helps with diversification. Correct answer is A. This topic is about alternative investment methods. The fund has expertise, wants maximum control, minimum fees, and to leverage its due diligence team. This points to direct investment first. Direct investing means the investor selects and manages the investment itself with no intermediary, so full control, lowest fees, and uses its own team. Correct answer is C. Fund investing means the investor gives full control to the fund manager and pays relatively high fees. Co-investing gives some extra control and lower fees than pure fund, but still uses the fund as intermediary. Investors with limited resources and/or experience generally enter alternative investments through fund investing. Fund investing means the investor contributes capital to a fund, and the fund handles identification, selection, and management. Hedge funds are highlighted as one category of alternatives, and the pattern applies to them too. Correct answer is C. Direct investing requires full internal control and expertise, not suitable here. Co-investing usually comes after some fund experience and still involves a fund relationship. Co-investing usually comes after some fund experience and still involves a fund relationship. This topic is about alternative investment structures. Limited partnerships where limited partners are investors and general partner runs the fund. Most terms are in the partnership agreement, but extra or special rights for individual limited partners are often handled separately. Side letter is a way to give certain investors extra negotiated terms, like excusal rights. So the correct answer is B. A prospectus is for public funds, not private venture capital funds. A management agreement is between the general partner and the fund entity, not individual limited partners. Management fees in private equity funds are often 1% to 2% of committed capital. Committed capital is the total amount limited partners promise to invest over time. This means the general partner gets paid based on the full commitment, even if not all capital is called yet. Fees based on current assets under management push managers to invest quickly to grow the fee base. Performance fees, the carried interest, reward good returns but come after a hurdle rate and do not directly address patience in capital use. The key is decoupling pay from immediate capital deployment. Committed capital does this best. Correct answer is A. Performance fees, also called carried interest or carry, are paid only after the fund meets a hurdle rate, the preferred return. In private equity, distributions often use a waterfall structure. If early profits lead to carried interest payments, but later losses bring cumulative returns below the hurdle, the general partner must return excess carried interest already received. This protects limited partners and is a specific provision mentioned in the context of whole-of-fund waterfalls or clawback mechanisms. Correct answer is C. Private equity funds as limited partnerships with management fees paid early and ongoing, typically on committed capital. Gross returns come from the fund's investments. Management fees are deducted before any performance-based distributions. Net returns to limited partners are what remains after fees, including management fees, are paid. Investments generate gross returns, then fees are paid from fund assets. After that, net returns are distributed to limited partners. Option A is correct. Alternative investments use more complex and richer compensation structures to better align manager and investor incentives over longer periods. Performance fee, the 20% on returns above 8% hurdle, is an incentive-based fee paid only on excess returns. This means the general partner gets paid extra only when the fund does well above the minimum return promised to limited partners. B is correct. It is not paid regardless of performance, and it does not fully protect limited partners from all fees when the fund underperforms. Management fee is still paid. Management fees are 1% to 2% of committed capital for private equity funds. Performance fees with a hurdle rate are common in private equity or venture capital limited partnerships. Mutual funds are traditional, regulated, and do not use committed capital or performance fees with hurdles in this way. For hedge funds, management fees are typically 1% to 2% of current assets under management, not committed capital. The performance fee is earned only after the fund achieves a hurdle rate, the minimum return the general partner must exceed. The formula pays the general partner only on the portion of return above the hurdle. 20% of any annual return in excess of 5% matches the formula exactly. Fee on the part above 5%, not the whole return. This is a hard hurdle rate. Fee only on excess return above hurdle. No fee on the first 5%. A soft hurdle will pay on the entire return once the hurdle is met. High watermark is about recovering prior peak net asset value, not mentioned here. The structure is a limited partnership. Managers are general partners who run the fund and have unlimited liability. Investors are limited partners who have liability limited to their capital commitment. Investment advisor is not mentioned as a partner in the limited partnership structure. The answer is B. Performance fees are earned only after the fund exceeds the hurdle rate. In private equity, if early gains lead to carried interest payments, but later losses cause cumulative returns to fall below the hurdle, the general partner must return excess fees already received. This is called a clawback provision. It protects limited partners and ensures the general partner only keeps fees if the fund ultimately delivers the required return over its life. High water mark is a hedge fund concept, not returning fees, but preventing fees until new peak net asset value is reached. Catch-up clause lets the general partner receive a larger share of profits after limited partners get their preferred return. It does not involve returning fees. The fund made 15%, which is more than the 7% hurdle rate. This means the manager is eligible for performance fee. In a soft hurdle structure with a catch-up, the manager is entitled to their specified percentage, 20%, of the entire return once the hurdle is cleared. Simply multiply the total return 15% by the performance fee percentage 20% equals 3.0%. If this were a hard hurdle, the manager would only get 20% of the profit above the hurdle, which is 20% of 15% minus 7% equals 1.6%. This is option A, which is incorrect here. Limited partnerships use complex compensation with management fees and performance fees. Performance fees are paid based on excess returns after a hurdle rate. If early profits lead to performance fee payments, but later losses drop cumulative returns below the hurdle, the general partner must return the excess fees already received. This protects limited partners and is called a clawback provision.